Hello and welcome to this YouTube channel for ACCA FR exam prep. My name is Adam. In this video, I'll be taking you through how to account for sale and leaseback transaction. Now, let's look at the example. Starting with a requirement, so let's start with a requirement. Show how the above transaction will be accounted for in the year ended 31st May 20x3. Now, the details of the question. William owned a building on which it raised finance. William sold the building for $6 million. And anytime you are accounting for sale and leaseback, we need to identify the sale process. So this is the process. Is fair value to a finance company on 1st June 20x2. Like we have always done, you need to reconcile these to the year end to know from the date of the sale to the year end whether it is 12 months. And this is 12 months. Very important. Now, again, in accounting for sale and leaseback, remember we have to compare the fair value to the sale process. And always remember the principle: if the fair value is equal to the sale process, then we say it's a normal sale. However, you have to also note that if the sale process, so just to expand on this before we look at the details, if the sale process, so I would say SP, is more than fair value, the difference we say is additional finance. The difference is additional finance, which we have to take out of the lease arrangement. So the extra amount becomes a loan, the financing arrangement. All right, now back to the details of the question. Now the same building was leased back from the finance company for a period of 20 years. The remaining useful life of the building is 25 years. The lease rentals for the period are $441,000 payable annually in arrears. The interest rate implicit in the lease is 7%. Now, the present value of the lease payment is $5 million. The transaction, so here is the key. The transaction constitutes a sale and leaseback in accordance with IFRS 15, revenue from contracts with customers. So let's see how we account for this. Now, because this is a sale and leaseback, I want to take you through the process. So at 1st June 20x2, which I will call the initial measurement. The initial measurement. What should happen? At the initial measurement, two things should happen. One, we have to calculate what we call the right of use retained. Because here you have William, who owned a building previously, but now they have sold that building and leased it back. So in effect, they have retained some economic benefit in the asset for which they are going to use, and that they must account for the asset element in that right of use. So the right of use asset retained, so the right of use retained, and this is a must-learn formula. So the right of use asset retained is equal to the carrying amount of the asset times the present value of the lease divided by the fair value. Very important. So to break it down, this will be carrying amount times present value of lease over fair value. And this is how we account for the right of use retained in the asset. And this is a must-learn. It's a must-learn formula. Now, the second thing to do at that initial measurement is to find what we call the gain transferred. The gain transferred to the buyer is what the seller must recognize. So the gain transferred is calculated as total gain on the sale less the gain relating to right of use retained. And this is also a must learn. So we have to look at how to calculate these two figures at the initial measurement. So let's start. For the right of use asset, we need the carrying amount. So from the question, let's see the carrying amount. So from the question, the carrying amount of the asset was, so we put it here, 3.6. Now times the present value. And from the question, the present value of the lease payment was 5 million. And the fair value was 6 million. So let's put it together. It will be 5/6. And this should be equal to, so 5 divided by 6 times 3.6. This is giving us 3 million. So look at it. The right of use retained, which is the asset to be recognized, is 3 million. What was the total value of the asset? 3.6. I mean the carrying amount. So the reason why this figure is so huge or large is that, look at it. The seller, who is William, is going to use this property for 20 years out of the 25 years. So the right of use retained will represent a larger part of the total carrying amount of the asset. Very important. Now let's calculate the gain transferred, which will be recognized. Now the gain transferred, which is the difference between the total gain. Now what is the total gain? It is the proceeds, which is the fair value less the carrying amount. And from this question, the fair value is 6 less the carrying amount 3.6. So here the total gain will be 2.4. Now it is less the gain relating to the right of use retained. And that gain relating to the right of use retained is a total gain 2.4 times the present value over the fair value. And this is also another must learn. It's a must learn or must know formula. So the gain relating to the right of use retained should be the total gain times present value of the lease divided by fair value. So this 2.4 minus, so let's see, this will be 2.4 times 5/6. So let's check that. So 5 divided by 6 times 2.4, that gives us 2. So when we take it from 2.4, we are left with 0.4 million. And this will be recognized in P&L as gain on disposal or gain on sale. Very important. Now, having learned how to account for the sale and leaseback at the initial measurement, which is the date of the transaction, let's see how we account for the transaction subsequently, which is at the year end. So to build on this, all right, let me push it to the other end. Very simple. So here I'm looking at, good, let's do it here. So at year end, which is 31st May, I'll look at two things. Is the right of use retained? So the carrying amount, which is the asset value, which is 3, minus the depreciation. The depreciation will be based on a straight line, and the number of years is 20. So you have this, and this should give us, so 3 divided by 20, we take from 3, we have 2.85 million, and this will be the carrying amount. So in a financial position statement, you have this as part of the non-current assets, and this would represent the depreciation for the year, or depreciation per annum, and that is 0.15. Now, the second thing to do is to look at the amortization. So I'll do for just the first year. So the first year end, which is 31st May, then this should be X8. Let me just refer. X3. So let's look at it. This is X3. So like we have built on, we have opening balance, we have finance cost, which is the effective. Remember, it is lease payable in arrears. And then I have the rental paid, and I have closing balance. So the opening balance would be, let's say this is in thousands. The opening balance would be 5 million, which is 5,000 here. Then I have the interest, which was given as 7%, I guess. Let's see. Yes, this is 7%. The implicit rate, 7%. So 7%, let's do that quickly. So 7% of this. So 5,000 times 7%, that gives us 350. And the rental paid will be 441, and that will be a deduction. So let's see. So that will be 5,350 minus 441. That will give us 4,909. So we go to the next year so we can find the carrying amount. This will be X4, 4,909. Again, 7% on this. This will give us 344. And we have 441 again. So 4,909 plus 344 less 441. This gives us this at year end 31st May 20x3. Then the current liability will be equal to 4,909 minus 4,812 minus 4,812. So let's see, 4,909 minus 4,812, and that is 97. So 97, and that approximately is 97,000, and that will be the non-current liability component. So it's a very long one, but just to ensure you understand what to do when there is a sale and leaseback transaction, how we account for it, initial measurement, subsequent measurement, which is the year end. I hope this helps you in your preparation for your FR exam. Please subscribe to this channel to receive updates on new videos.